What's up, everybody? How was your week in the market? If you invest in small caps, you probably did well. Large caps were suffering. Let's see how the spider did the past week. Yeah, just recommend a ticker. I'll do live DCF models, and we'll just look at the financials real quick. I think that's what people like anyway on this channel. So let me look the past. Let me go to past month. Yeah, it got rocked. Alex, what's up? 564 to 548. So it's like a 3% drop. FF. Okay, let's do Beyond real quick. Beyond. Isn't Joey Chestnut partnering with? I don't know if it's Beyond, but he's partnering with a plant-based hot dog company. %8.5%. I know I definitely looked at this before. Beyond Meat. It's really, it shot up pretty quickly when it IPO'd, but I think after a month, it's really done nothing. Let's just look. Yeah. Like it IPO'd in, come on. In May 2019, it peaked. Yeah, after 2 months, it peaked at 230. Wow. It went from 66 to 230. And then it came down a lot below its IPO price. But surprisingly, it tripled. Well, maybe a little more than double from that bottom, but it's really gone downhill the past 2+ years. Sheesh. I'm sure if you bought it, you're probably holding on because you're probably at like an 80% loss, 90% loss. That's a tough one. 400 million, 613. And 400 million is a pretty small market cap. So if you're looking for like a 10, 50x, you can do it with the 400 million. It's a lot harder to 10x with a stock that's like 100 billion. Of course it's possible, and NVIDIA did it, but it hardly ever happens. Beyond. I used to buy Beyond Meat. I haven't. Down 60% in the past year. So they have negative free cash flow going out. So that makes it a little harder to value. Let's just do a 400. Okay, they're at 400 million right now. So let's, in 3 years, if they get to 500 million at a 10% conversion. So if they get 50 million of free cash flow in 3 years, that's what I'm assuming. Which seems, so I'm at $38. And that's not an aggressive assumption. That's just assuming they grow at a moderate 5% a year, but they convert 10% of their revenue to free cash flow by, I guess, 2027. But if they don't get the positive free cash flow, it's really lights out. You can't. You gotta generate profit at some point, and they haven't done it yet. It was negative 50 million. It was negative 570 million in 2022. I wonder why, because their revenue is going up. Their revenue, it was 16 million in 2016. Then it doubled to 32 million. Then it doubled again to 68 million. I guess it's come down. It peaked at 460 million in 2022. It's come down since then. It's come down a lot too, not just a little, from 460 million to 326 million. So I think they're just losing too much market share. Beyond Meat. That's a pretty significant drop. 460 to 326. So that's a 29% revenue drop. In 2 years. Usually you'd expect revenue to be going up, especially at this early stage. They really have to be above $1 billion just to kind of cover their costs. That takes a little while, because you can do a quick DCF model, but it will take a while to identify why it's dropping. I might be able to do it in 10-15 minutes, or it might take me an hour or two to figure out. We have to kind of go through their financials, but we could definitely do that. FutureFuel. Somebody had a good question. Ed A to Z had a good question about a company with negative, that was paying out more money than their net income. They had like 110% payout ratio for the past few years. That would be a good thing to talk about on a live stream. Oh, fuck. Okay, FutureFuel. Okay, I'm just gonna make this a different color. FutureFuel. It's another tough one. You're not making it easy. FutureFuel. Well, they do have positive. Oh no, it's nobody's projecting. Okay. So nobody's projecting their future. We could just take the past and extrapolate. They do have positive free cash flow. Its highest ever was 100 million. Let's just keep the 30 million equals 0.03. Okay, FutureFuel. 200 million, 534. Okay, I'm at $11. They're trading at $5. The market cap has come down a lot lately. I did a video on them. I wonder what my valuation was. That's my favorite thumbnail. FutureFuel. Okay, I was at 23 a year ago, almost exactly a year ago. I was at 23. I wonder why it's coming down so much. So I'm at 11. They do have positive free cash flow. They pay a dividend also, which is pretty surprising. A 4.5% dividend. They IPO'd in 2011 at 10. The highest ever was 21 in 2014. So they're pretty much trading almost at their all-time low. I think their all-time low was last month. It got to $4. That was the all-time low. It's not a bad dividend. I mean, it's really surprising when they're paying a dividend. They're not really making money. Well, they make a little bit. It sells bio-based fuel and bio-based specialty chemicals. Yeah, Sofi is popular. A lot of people like Sofi. They got the banking charter, Sofi, like a year ago, so they're able to borrow at lower rates. A lot of people are picking Sofi as a stock that's going to like really grow a lot. I don't know. I mean, I own Nubank, which is similar. It's also a fintech company, and I'm up like 220% on that. So I'm not sure. I mean, Nubank is in South America. They're Brazilian, so they have a pretty big market base in South America. They're the leader by far in fintech banking. The free cash flow is projected to be positive this year or next. 500, 600, 800. I would say $9. I'll give you a little more. I'd say $11. That's my value for Sofi. $11. I think there was a better entry point. Yeah, it started at $18 in January 2021. And it peaked the following month. That was its highest point ever, 25 in January 2021, right after IPO. So a really good entry point was trading below $5. Oil going up. They close to an entry point. NWBO, that sounds interesting. Yeah, Sofi, you could really spend a lot of time digging into it. But what, I don't know why isn't Sofi doing better? You would think it would be doing better than it is. It's only what, 7 billion market cap, 8 billion, 8 billion market cap. Come on. And new, which is fintech, is 65 billion. That's my best investment percent wise. I think I'm up like 220%. NWBO. Northwest, 11%. $0.39, $4.69. If you ever see a stock like go up like 50x in one day, I'm not 50x, 50% or 80% or 110%, it's usually a biotech company. They tend to move a lot. They have big swings. Sleeping on PE, Scott. When will you ride the Ari's train? Ari's train? Okay, what is Ari's train? Was that a typo? Oh, Ari's management? Yeah, let's look at Ari's next. But this looks interesting. If they are, you said they completed phase 3? Completed phase 3 trials on the cancer treatment and they're currently treating patients in the UK. That's promising. That's very promising. It's hard to predict this stuff because I'm sure they don't have much revenue, probably no revenue. Okay, they have a million of revenue. Yeah, you can't really do DCF on this. It's more about like what you said is just looking at the drugs they're working on and seeing how close they are to commercialization. But phase 3, is the last phase. So once they complete phase 3, they get FDA approval, and then they can start selling the drug. It's a development stage pharmaceutical company that focuses on developing immunotherapies against different types of cancer, founded in 1996. Okay. It relies upon the contract manufacturing organization Cognate Bioservices for supporting manufacturing clinical trials. Their relationship with Cognate began in 2007. Cognate. Is that a public company, Cognate? Cognate is a private company. Okay, that's. I mean, I never heard of them, so that makes sense. So here are the 3 products. DC Vax L, phase 3 in Europe and USA. DC Vax Direct is a therapy to treat inoperable solid tumors in phase 1. So they have two products in phase 3. That's big. Some companies never get a drug to even get to phase 3. So that's the thing with I want to get better at this, at trying to like time stocks better, because I have a hard time doing that, because you could make huge amounts of money, like double and triple your money, before a company ever generates any revenue. Stocks like this, if you could somehow keep track of the drugs they're working on, and as soon as they announce they pass like phase 1, phase 2, or phase 3, just the announcement, not even selling any drugs, the stock goes up a lot, because they're getting that much closer to commercialization, to generating revenue. How do we know when you're going to do a live stream? I know, I don't really have a system. I just kind of, when I have free time, perhaps a takeover target. I don't know about that. I think a takeover target is generally a company that's profitable, that's generating cash flow. Because if you think about it, like if you have a company like that's really not generating revenue, right? You're just in the R&D stage. You could pretend you're a biotech company, and you're in the R&D stage trying to develop a drug or vaccine, or maybe you're just trying to invent a new technology, whatever it is. No one's going to ever pay you enough money where you would sell it, because no one would, if you have no revenue, no cash flow, no one's going to give you like $100 million or $50 million for a company that's not generating anything. So that's the hard part with acquisitions. You have to have both parties agree. So like if you're not generating any revenue, maybe someone's going to offer you like nothing, like $1 million or $500,000, and you wouldn't sell it because you're already putting in so much work. So I think generally a takeover target is a company that's generating profits. So if you were to buy a company that's, and it doesn't have to be a massive company, it could be like you're just a small business owner, and there's another business generating $2 million of revenue a year, and like $200,000 of profit. So you would say, I'll buy your company $400,000, 2 times profit. Because unless there's profit, it's kind of like it's hard. It's really hard to value, and the parties generally won't agree on a price. Well, that's just my theory on it. I could be wrong. Ed, I was talking about you, Ed. Yeah, Ed, I was gonna say it would be good if you came on a live stream, then I could answer your question a lot better than trying to fit it all into. It was about a company's paying above 100% payout ratio. How can they do this? I could give you a theoretical answer. Which company, Ed, were you talking about that has above 100% payout ratio? Um, 9.5%. Because you could have above 100% payout ratio. Do you guys know what I mean by payout ratio? It's dividend over net income. So if you pay out $100,000 in dividends a year and your net income is $200,000, so your payout ratio is 2. So you can cover your dividend twice. So that's kind of like how some dividend investors look at the payout ratio to figure out, will this company be able to pay a dividend in the future? In this case, they could afford it. They could afford their dividend twice. If it was even lower, if they paid $50,000 dividends a year and a net income was $200,000, they could cover their dividend 4 times. So that generally a higher dividend payout ratio, the better. But you have to remember that the payout, so with some companies like REITs and oil and gas companies, sometimes net income isn't really a good indicator of how the company's doing, because what if they have huge amounts of depreciation expenses, which drags down their net income? So they might actually have a lot of cash flow, but like for instance, if a company was paying $500,000 in dividends and $400,000 net income, they can't even cover their dividend once. But if they had $2 million of free cash flow, we can see they can easily cover the dividend payment. So first thing I would say is that you want to look at the free cash flow, not the net income, because net income is really is your accounting profit. It's not real cash. So look at the free cash flow, and if they can't cover their dividend from the free cash flow, there could be a problem. But that doesn't mean they can't afford the dividend in the future. Let's do CrowdStrike. I've been talking about CrowdStrike for a long time. Yeah, is KMI? So let's do a deep dive into KMI. But first, let's do Aries, since that was suggested first. And I'm curious about Aries as well. 147 to 46. $147.46. Yeah, I'll show you. It's pretty easy. I'll show you on Yahoo Finance how to do this. But it's a good question. It could get real nuanced. But it's just like if you have a friend that that has a nice car, nice house, they can maintain that lifestyle for a number of years, possibly a decade. But at some point it'll blow up if you have a friend who wants to show off, right? And his monthly expenses are $10,000. But his income, after taxes, things like that, is $8,000. So he's short $2,000 a month. So it's the same thing as a company paying a dividend more than their profit. So you might say, how could my friend afford much nicer car than me? And his house is nicer, and I know I have a better job than him, and we're always comparing ourselves to other people. So you can cover that shortfall, $2,000 a month, $24,000 a year he has to take on in debt, but it'll blow up at some point, or when he retires he has no money left. Same thing with a company; they can afford to pay a high dividend, more than they make. But it's going to blow up at some point because your friend will need to take on credit card debt, or maybe work the graveyard shift because he's not cutting his expenses. But I thought you swapped dividend payout ratio with dividend coverage ratio. I meant dividend. I meant dividend cover. I meant dividend coverage ratio. I meant how many times they cover their dividend. Payout ratio. I guess they're just you could just swap the numbers, but I think you know what I meant. KMI is a good stock, a nice midstream stock. It's really undervalued. Okay, I'm at 258 for KMI. I'm surprised how undervalued it is. KMI, Kinder Morgan. I think they're like the third or fourth largest midstream stock. Okay, here we go. So slow. Okay. Kinder Morgan. I'm on a. Wait, I'm on. Okay, that's what. How do you join? You could join. You could just hit this link. Okay, we're on Ari's. I'm like combining things. Oh, Ari's has negative. Oh boy. Yeah, Ari's is in bad shape. Why do you like Ari so much? They're losing money year after year. They're in pretty bad shape. They have too much debt. They can't afford to cover their debt payments. This is a REIT, Ari's? It's an asset manager. It's too. Okay. So $5 billion of revenue. Yeah, I think they're in bad shape. I'm surprised an asset manager loses so much cash flow. You would think. Ari's is a alternative investment manager offering clients. Yeah, if anybody wants to join, you could join a live stream. You don't even have to talk much. You'll learn a lot. Okay, global investment manager. Okay, private equity, real estate markets. It doesn't look great, but okay. So let's do KMI real quick, because somebody mentioned, how does a company, if they can't cover their dividend year after year, how do they stay in business? And So a 5.35% dividend. Yeah, right. This is right. The payout ratio is 104%. So their dividend is higher than their net income. But it could be a timing thing. You always have to look at over time. Let's here's their net income. Hey Ed.
Hey, can you hear me?
Yeah. So you wanted to talk about KMI?
Yeah.
Is that yeah? Is that so you wanted to talk about KMI?
Yeah. Yeah.
Is that yeah? You could turn your you wanted to talk about KMI? The live stream.
Yeah.
Mute the live stream. You could turn your you wanted to talk about KMI? The live stream. Mute the live stream. You could turn your you wanted to talk about KMI? The live stream. Mute the live stream. You could turn your you wanted to talk about KMI? The live stream. Yeah, I muted you. Let me know when you turn the live stream, the volume off of the live stream, because it keeps coming back to me. Did you turn it off? So their dividend currently is 5.35%. Did you turn it off? 48 billion. So the dividend currently is 5. You still have the turn. You got mute the. So did everybody understand Ed's question? Okay, so Ed got an interesting setup. Hello. So Ed's question was, how could a company pay more in dividends than their profits? So they can't even cover their dividend. So they can't even cover their dividend. You still have.
It's not doing the normal thing.
So they can't mute the computer. So their profit in trailing 12 months was 2.4 billion. They pay 2.6 billion in dividends. Because if you guys watch my videos, you know that net income, which is an important thing to look at. I'm not saying it's not important, but it's not cash. So it doesn't give you as good of an indicator of how the company's doing. So you want to look at free cash flow, because that's the actual cash. Over time, over 20, 30 years, it should equal. Net income should be similar free cash flow. But in any given year, it could spike around. So if you want to look at a true coverage, you could free cash over dividend, so they can cover it 1.5 times. But you should look at it over a longer period of time anyway, especially with midstream companies, because they have so much depreciation. Like when you look at a REIT owns a lot of real estate, or a midstream owns a lot of infrastructure like pipelines or terminals. They have debt financing on selling equity shares. Infrastructure like pipelines or terminals. They have debt financing on selling equity shares. Maybe we should just pipelines or terminals. They have
You
debt
can use your phone to watch the.
I don't know. I guess we'll just deal with it. Pipelines or terminals. They have
You
debt
can use your
financing
phone
on
to
selling
watch the.
equity shares. I don't know. I guess we'll just deal with it. Pipelines or terminals. I can't. It's driving me nuts hearing my voice. It keeps coming back like a loop. So that's generally what I would say. Look, like they can cover their dividend because the free cash flow is the true number. But if you looked at it over a long period of time, last year they had 2.5 billion, which was about their dividend. Before that, 1.8 billion. But yeah, because you could see in other, they took an $800 million loss in other, and 2020 a $1.2 billion loss. It's just a lot of noise. So that's why I say just focus on the statement of cash flows, because you don't have to do any math. You don't have to like strip out numbers. Because like say your salary is 100K, and then you after taxes you're like 70K. But like it's possible one year your salary after taxes is actually more than your salary. Like you have like 110K. I mean, you might have bought solar for your house. That's like a $40,000 deduction. So that's so I know most individuals don't have many write-offs to deduct, but companies generally do. If you own investment properties, you might depreciate a lot one year. So it could make it harder. So I just recommend looking at free cash flow. It's probably a better indicator. But there are some companies, I think like Ford, I think they've been taking on debt just to fund their dividend. Did you get it muted? Or it's still? I don't hear myself, so that's good. Yeah, I guess just shut off YouTube. But it sounds like you fixed it. Are you there, Ed? You hear me or no? I don't think you can hear me. Check out ACGO when you can. I let Victor know about this stock and he really liked it. ACGO. But yeah, but Kinder Morgan, these midstream stocks, they're really safe. I mean, it's almost as safe as you can get because it's kind of like somewhat guaranteed income, because every upstream company has to move oil to the downstream, and they lock in these contracts with Kinder Morgan, Energy Transfer. what's that midstream company in Canada? Suncor. But timing is important with these midstream stocks, because if you buy it when oil prices are really high, you're probably never going to make much money. So if you buy it when oil prices are really high, you're probably never going to make much money. If you buy it when oil prices are really, I can hear myself. The best way to do it is just use your phone if you need to watch the channel. Use your phone. I think that works. But yeah, it's just the echo keeps coming in out. ACGL. ARC Capital 96.36. 96.36. A good sized company, 36 billion market cap. If you want to if you want to 10x your investment, of course, I don't know what's going to 10x, but if you want to play the odds of 10xing your investment, pick a stock between 1 and 5 billion or 1 and 10 billion, because you're never going to really 10x. You know, you can spend the rest of your life trying to 10x on a stock that's over 100 billion market cap. It happened. Nvidia did. I mean, of course, Microsoft did, but it took a couple of decades. Nvidia is like the only one that did it in a short amount of time. But if a stock is like 2-3 billion, you drop super glue and it starts smoking. You don't hear that every day. Our capital. Our capital. You could write in the comments too, Ed, if you need to communicate until you fix that. There's nobody's projecting the future anymore. I don't understand this. Okay, here it is. Once again, no one. 6.
Hey, Scott, can you hear me?
Yeah. You got it fixed? Yeah, I can hear you.
Can you hear me?
Yeah. You got it fixed? We're still getting that up.
Well, I'm using my phone to hear you. And there seems to be a huge delay. Well, I'm using my phone to hear you.
Yeah. I hear myself in the background. You can just write in the comments. This looks our capital. Does anybody know about this company? Our capital. Oh, insurance. I knew it had to be either insurance or a finance company. Yeah, it's hard to really use a traditional DCF model to value insurance company. I mean, you could try. Insurance, reinsurance, mortgage insurance.
Can you hear me?
Yeah. Yeah. You got everything fixed over there?
Can you hear me? Kinder Morgan,
Yeah.
KMI.
Yeah.
I doubt it.
Okay. Oh yeah, so I was just showing
That's gone sideways for 5 years.
yeah, you're saying their net income can't cover the dividend.
So how can it afford?
So I would just focus on if you go to Yahoo Finance, you go to KMI, you can just look at their cash flows, the statement of cash flows, and you can see. I think they pay $2.6 billion in dividends currently, and I know their net income is lower. Like in the past 4 years, net income, it was never even 2.5 billion, the highest. But when you look at KMI, midstream stock, they have huge amounts of depreciation. So net income gets really skewed. If you look at it like a tech company, net income is fine. But for like a REIT with real estate or you probably just want to look at free cash flow. And you can see they had 3.9 billion of free cash flow in the trailing 12 months, 4 billion in 2023. So plenty to cover their dividend payment. I mean, the worst year was 2.8 billion. That was in 2020. And that was still enough to cover their dividend. But even if a stock can't cover the dividend, even the free cash flow can't cover the dividend. What's that?
Net cash flow, is that after they pay their debt?
Yeah, free cash flow. Yeah, that's what's remaining to pay a dividend. It's everything left over after every expense. And so a company can either pay a dividend with the free cash flow, buy back stock, or reinvest in the business. So that's what's remaining after every expense. The cash that's remaining. Yeah, the reason I say net income, if you have a 20-year time horizon to look at the stuff, it's fine. But in any period, it's going to be skewed a lot. Net income, just accounting. Like you could see in 2020 and 2021, they took these billion-dollar losses from the sale of a business or the sale of an asset. Because if you have $50,000 of income from your job, you know that's how much cash you have. And let's just say, for instance, you bought a house in 15 years ago. For like $200,000, and now you sell the house for $150,000. Even though the mortgage is totally paid off, you're going to get $150,000 of cash when you sell the house. But your net income is zero because you have to take a $50,000 loss because you bought the house at $200K and you sold it for $150K. So your accounting profit is zero, but you actually have $200,000 of cash flow for the year because you have $50,000 from your job and then you sold the house for 150, right? So it's a big difference. Net income of 0 or cash flow $200,000. Does that make sense to other people? Like, but this is just a simple example. But they have like probably $20 billion of pipeline infrastructure that they depreciate, or sometimes they sell for gains or losses. So without trying to explain everything about it, it's just easier just to go to free cash flow. And you should look at it. Same thing you would look at net income. Look at it over 3-4 years and take the average. And you can see you said, oh, their net income the past 5 years is like the average is lower than their dividend. But if you look at free cash flow, it's well above. They're averaging probably like $3.7 billion a year in free cash flow. Did I do that up here? What do you think about?
So does this mean they make extra money, like in the stock market on investments? Or?
No. Look at that. I said 3.7. It is 3.7. No, they don't invest any money. I mean, they might, but that's not their business. Is transporting fuel from one party to another. It's hard to explain. I mean, it's just that they have a lot of expenses that bring down their net income. And that's why their net income looks bad. In some years, but their cash flow looks good. But I try to give an example. I know it's hard to give an example because this is not what, but a real life example. Maybe I should. Let me mute it again. So like in 2014, you bought a house for $200K. I feel like this example won't work either because you really have to understand accounting. In 2024, you sold and let's just pretend you pay down the house over 10 years. You paid it off. Even every month you paid extra. So on your income statement, I mean, you don't have an income statement, but it's pretty much like an income statement. Your what you give to your accountant, how much money you made for the year. You actually lost $50,000 from this home. You paid $200. You sold it for $150. So you lost $50,000. I think this is a good example. What do you guys think? Is this a clear example? Does this make sense? So you pay $200 for the home in 2014. 10 years later, you had to move for whatever reason. The housing market suffered.
Pay $200 for the home.
What's that? Maybe you should just totally mute.
The delay is playing with us.
No, but you don't
So you
need
pay
to hear.
200,000 for the home.
Yeah.
You sell it for 150,000.
You actually
You sell it for 150,000.
You have to report on your taxes. You lost $50,000 on this investment. Because you sold it for less than you bought it for. And if you just happen to make $50,000 at your job,
Right.
So you would, for the year, you show on your income statement you made nothing. I mean, you don't have an income statement, but it's kind of like an income statement. This is your income statement is the profit and losses for a company. You lost $50,000 plus inflation in 10 years. Yeah, I know I know you didn't lose 50. You know, you did lose 50,000, but I know you got your rent paid. You didn't have to pay rent for 10 years. But I'm just talking about from a pure accounting standpoint. But like I said, over the past 10 years, you paid down the entire $200,000 mortgage. Let's just pretend in 2014 you paid $200,000 for a house outright in cash. You had $200,000. But in 10 years you took a loss. So you have to show that loss to your accountant. So for 2024, your profit is zero. But if you did your statement of cash flows, which is equivalent to if you looked at your statement of cash flows, you actually made $50,000 at your job, and then you got $150,000 of cash from selling a house because you sold it for $150,000. The loss happened 10 years ago. I mean, the $200,000 happened 10 years ago. So in 2024, we're just talking about cash in 2024. You actually generated $200,000 of cash flow. So this is a real simplified example, but a company, they have $70 billion of assets. So they're writing their depreciation. It's mostly depreciation because it's midstream. But it's a lot of depreciation, a lot of write-downs. So that's why instead of trying to explain accounting, I would just say, just forget about net income. Just look at the statement of cash flows to see how much cash they generate. So they generated $3.9 billion of cash in the trailing 12 months. So plenty to cover their dividend. So they generated $3.9 billion of cash in the trailing 12 months. So plenty to cover their dividend.
Hey, Scott, I don't know why the lag is the way it is, and I can't seem to fix it. So I'll just leave you with this and drop off.
Yeah. You can just talk in the comments.
I have been selling Kinder Morgan here lately, and I've been making 30 to 33% profit on my sales because when I bought it. And
no, that's good.
I'm pretty sure I learned about this stock from you, so I'm appreciative for what you've done for me.
Oh, definitely. That's good return. And I try to do the same thing. I try to look at a company and try to understand their finances and say, okay, this is a good time to buy. But sometimes looking at their finances, sometimes you just might get lucky. because there's so much. Like for instance, this particular stock, it's really about if you buy it. Like it doesn't really matter if the company's making money or losing money. It matters, of course, but the most important thing is the price of oil. Like when I bought Energy Transfer, the price of oil was low, so I was going to make money no matter what. But if you buy a stock like this when oil is trading when a barrel of oil is above $90, you're never going to make any money on a stock like this. Even though you're getting a dividend, it'll take 20 years. So with a commodity stock, it's a little trickier. But you should still always, of course, look at the company and try to understand it. Okay, yeah. Most people, when they're on the live stream, they don't have. I can't even think. They usually don't have the video going on as well. I forget how they do it. But yeah, but thanks for hopping on. We'll do it again another time.
Yeah, I'm having to use. It forced me to use StreamYard for this one, and I literally cannot find any setting that works.
Yeah, because this is StreamYard. That's the program I use for my live stream. So
I'd like to do this again sometime, but
yeah, no problem. Just talk in the comments. That's probably the best way to communicate. I'll talk to you later.
All right.
Okay, bye.
I'll bid you adieu.
Okay. I'm interested in iHuman, but hard to tell. The company can't keep growing. So so Kinder Morgan, you can see the red line is the price of oil, Brent crude, and Kinder Morgan's the blue line. You can see they both, when you compare on Yahoo Finance, they always start at the same spot, and then they move based on percentage changes. So you can see the price of Brent crude, it started pulling away from Kinder Morgan, but they have to come together at some point. Like you can't separate, because it's pretty much linked to the price of oil. Same thing if you buy like a stock that mines gold. The price is pretty much linked to the price of gold. There's going to be some variation because, oil doesn't pay a dividend. It's just the price of the actual commodity. But stocks pay a dividend. And of course, stocks, there's other things going on. But you can see they're coming back together here. And you see Shell. Shell actually almost tracks Kinder Morgan really well. So they all three, Shell, Kinder Morgan, and the price of oil, they all start. This is 5 years. I'm going back. They start at the same point. Everything starts at the same point. Of course, they're different prices, but they start. The base year is, and then they move on percentages. So you can see they kind of came together after 5 years. It doesn't have to move perfectly, because what if a company, what if the CEO is, the CEO of the company, goes to jail, the stock's going to crash, even if oil goes up. So it's not 100% linked, but it's pretty, unless something extreme doesn't happen. Like the company goes bankrupt, it's going to go to zero, regardless of where oil prices are. But as long as the company stays viable, it's going to move with the price of the underlying commodity. And you can see oil is a lot more volatile, because the stock price, it usually lags. The stock price is based on information, right? So if the market doesn't have the information, it can't drive the price up or down. So as oil goes way up, so the stocks go up, but it's just lagging. It's lagging it because it just doesn't have time to react. Same thing if oil goes down, it goes down further until the stocks can react. But I wish I could be a day trader. I always hear people saying, they make all this money day trading. I'm pretty sure they're just saying that to either get views or just for their own personal benefit. But I think if you're day trading, you're losing money. Unless you're really good, like extremely high level, then you can probably make like a Warren Buffett kind of knowledge base. Then you can make a ton of money. But even Warren Buffett, I don't know if he can be a great day trader. I think it's just really kind of like playing the lottery. If you win a lotto, you're not great at like gambling. You're just got real lucky. iHuman. I mean, what do you guys think? This is just kind of, it's anecdotal, my opinion, but it's a pretty high whack. iHuman. Is that like a AI kind of company? 89 million market cap. Yeah, so you can't really value this company. 89 million. We could all get together, maybe buy half the company. They do have $1 billion of. Oh, it's Chinese yuan. Yuan. So it's about 130 million US dollars of revenue. It doubled from 2020 to 2021, but it actually came down in 2020. They make education apps in China. iHuman. So nobody predicts free cash flow anymore. They are cash flow positive. 165 million yuan. Okay. So they peaked at 200 million. Let's give them 100 million. What's there? $1.69, 89 million. Okay, it just seems risky. It's really risky. Oh my God, why do I keep doing that? I gave them a really high whack, and I assumed their free cash flow would be lower than their recent numbers, because they got 165 million of free cash flow in 2023. Let's keep it at 165 and I'm just growing at 10%. I give them a really high whack. I'm at 375. But they have a billion of revenue. 100. 130 million of revenue. So their revenue is higher than their market cap. They have a lot of cash. Yeah, I see what you're saying. They have more cash. They're trading below cash, which trading below cash, which not many companies trade below cash. That just means their cash is higher than their market cap. But that doesn't mean a company is a great buy. Because if they were such a great buy, then people would be buying it and the stock would be so much higher. You want to look at that cash burn. They're actually cash flow positive. They don't have a cash burn. So if you're trading below cash value and you're cash flow positive, it's a great investment. But it's in China. So that's the reason no one really is buying it, because it's in China. And you have the country risk built into that. It must trade OTC, right? It trades on NASDAQ. NASDAQ real-time price. Huh. It's a good industry, right? Education and training services. It's kind of like a stable industry. Like when you invest in these like junior miners, or you invest in these like tech startups, you never know. But this is kind of like a more stable, like a grocery store. Nice, stable cash flow streams. Yeah, it's risky because it's in China. Okay, they provide intellectual development products to users, kindergarten distributors in China. They've been around a while. Sometimes it's just hard to get accurate information on some companies. They had 1,100 employees. I guess you have to just assume that information is correct. So there's always a concern when you look at companies not in the U.S. that the information is not correct, because the U.S. is very, they scrutinize that information. Like if you lie on your report, like, I mean, if you said you had 1,100 employees when you really had 900, you're probably not going to get in that much trouble. But if you start, if you start putting it all together, you're lying about this, you're lying about like, who owns the stock, you're lying about revenue, which is terrible. Yeah, then you're going to run into a huge problem in the U.S. In other countries, I think it's undervalued. I wouldn't invest in it. I don't see much upside, but you could get real lucky. Because when it came out, it was strong. It came out right after the COVID crash. It IPO'd at 16. It went up 80% after a few months. It was a respectable. It went from. It was about 18x higher. So. So it was 1.6 billion market cap. So That's kind of my threshold is $1 billion. I wouldn't touch anything below $1 billion. I just think you're playing with fire, unless you really understand it well. But it was above $1 billion, so it was respectable to a point where I might invest in it. Now it's 90 million, so something doesn't seem right. And unless they paid a dividend, that's interesting. I look at conversations, like there's probably something out there, like some news article, and someone's going to probably talk about it. Pick some up at 983. IH has more cash than its market cap. We were saying that in 2021, that was the case also. I think this person's wrong. In 2021, they probably didn't convert from Chinese yuan to US dollars. It's hard to you try to do all this work, try to do all this due diligence, and then you never make any money because you lose money mostly if you try to take these risks. Like you try to find companies like gems, but I know what you're saying, but it almost seems like it seems too good to be true, right? But let's say it was 2 years ago we talked about this company. It could have been the same exact scenario. In 2 years, you would just watch. It would just be flat in 2 years. Thank God you didn't buy it. When it was $10, you'd be down like 80% now. So one bright note is it's not going down. At least it's steady, because if it kept going down, then they would do reverse stock splits. So at least it's been steady. They're basically selling edutainment apps to Chinese parents for their kids. It's a good industry. In China, it's probably one of the better countries to sell education, online education, because there's a lot of people in China, and it's really education extremely important in China. But it's if you get if Tencent invested in this company, the founder owns more than half the company. But if Tencent invested in them, the stock would go through the roof. Yeah. Any other stocks that you guys mentioned? Nail and carry more upside during this rotation. I wonder if I have a suit with that. Carry and nail. Carry. Oh. Regional banking ETF. That's interesting. Home builders and supplies, XXX leverage. That's kind of risky. Dow Chemical. Yeah, that's a good one. Triple X. It's such a, that's really playing a fire when you invest in these leveraged ETFs. This has done okay. Remember UCO? How's that doing? I remember when people buying UCO. I remember when oil was going up so much and actually did a regular split. UCO usually does reverse splits. You can see it was trading at $5,000 at IPO because of reverse splits. Yeah, there was the COVID and the oil crash, and the oil, when oil was negative in April 2020, but it was up like 15x from the bottom. It was as low as $3. This is a levered oil. It's bullish oil, but I think it's 2x levered. So if oil goes up 10%, this should go up 20%. If oil goes down 10%, this should go down 20%. But yeah, it got real like $4 maybe, and then it went through 50, and people are buying it on the way up. I mean, I knew it was going to crash. It has to crash. Mathematically, a levered investment has to go down over time. That's why they keep doing reverse stock splits. In a short period of time, it might go up. And amazingly, this went up from 2020, 2 years, it was a bull run, which is crazy because there's probably never a 2-year period where this stock goes up. Let's see. It went from 50 down to 21. That was in March 2023. So 6 months it ran up, which is, and then it came back down. It has to come down over time. I did a video on this. I think my first video explaining how levered ETFs have to go down over time. Nike, yeah, that's a good one too. Yeah, Nike. I don't know. I think there's more downside to go. WTRG. Essential utilities. Yeah, that's an interesting one, right? Regional banking ETF. So this is since 2006. It was 47. Its peak was 77. It must pay a dividend, right? It doesn't pay. I mean, how do you make money on a stock like this? Like, even if you bought at the very bottom, it doesn't seem like there's ever that much upside. So if you're looking at an ETF, you should look at the holdings if you want to know what's in the ETF. Because you want to make sure they're real assets in there. They just own stock in other companies, and they hold stock in regional banks. But if you looked at like this UCO, if you look at the holdings, well, Yahoo Finance doesn't have it, but they don't own any assets. They just own contracts, derivative contracts on futures. They own future contracts on the price of oil, and they just keep rolling the contracts. That's why they can't really make money, these leverage ETFs, because over time it's something called decay risk. They lose money every time they roll over the contract. So yeah, so this KRE, if you wanted to see what they hold, First Horizon, they're all regional banks. That's their biggest holding. Synovus, I'm thinking of Synovus, the tech company. Truist, I've heard of Truist. Kind of small, smallish banks. 8 billion market cap. WTRG. Essential utilities. 3% dividend. Look at this. A 12-to-1 stock split. Looks kind of odd, right? It was trading at 40, which is where we're trading at in 2019. $11.141. WTRG. Essential utilities, pretty low whack, 7%. See the so they have negative free cash flow. The forecast is negative. They always have negative free cash flow. 3850. Let's see. 2 billion. Yeah, I just have to assume they're going to have positive. At some point. They do have positive net income. They always have negative free cash flow. It's like, how do they afford? And they pay a dividend. That's amazing. So I'm at, I mean, it's kind of tough, but I'm at $16. I mean, maybe I could go a little higher. 30. But it seems pretty overvalued. But that's a tough one. Because they never have positive free cash flow. Okay, so I guess that's it. I'm kind of getting tired. Yeah, thanks for joining. Thanks for commenting. And I may do one tomorrow. It kind of depends on my mood, I guess. I'll talk to you later.